Well, all week we'll be focusing on the top performing mutual funds. Today we start with one of our Bloomberg Best U.S. Diversified Equities funds. The Morgan Stanley Mid Cap Growth Fund makes the grade. It ranks in the top 3% for the past 5 years and top 2% in the last year among its peers. Lead manager Dennis Lynch has been managing the fund since 2002, and he's joining us now to share some of his strategy and also to give us some picks, which people always, of course, want to know about. Dennis, welcome. Thanks for coming in.
It's great to be here. Thanks.
So talk to me first of all about your strategy. I mean, this is mostly a growth fund looking at mid-caps. What is some of the criteria that you use?
Well, we take a very long-term approach to investing. I think that's probably one of the things that differentiates us the most. The turnover of the products, the amount we change each year, is roughly 20 to 25%. So that implies we're taking a 4 or 5 type year outlook when we make our investments. And we tend to invest in what we consider to be very high-quality companies, ones that have very sustainable competitive advantages. We think they're truly unique. So in focusing on those parts of the growth market, we've over time achieved really strong results, and we think that focusing on stock picking is the way to add value as opposed to trying to guess what's going to happen in the market each quarter or in the economy each quarter. We think that's a more steady approach overall to the investment process.
One of the things I noticed when I was looking over some of your picks is that they either don't pay dividends or don't pay high dividends. And that's interesting given the environment right now. We've heard from a lot of investors who say go for large cap stocks that yield a lot. But obviously that's not something that you're terribly concerned about.
No, it's not that we don't like dividends. We actually prefer companies with strong free cash flow profiles. And most of our holdings actually have very strong after-tax free cash flow yields, which means they could, if they wanted to, pay high dividends. It's just that they've chosen not to because we think, or they think, they have the opportunity to reinvest that money at a very high rate of return. And as an equity investor, that's something we would prefer for them to do rather than give us the money back.
Well, let's get to one of these picks. Ultra Petroleum is what this company is called. It's a natural gas exploration and production company, Green River Basin of Wyoming. And one of the things you like about this is its cost structure. Talk to us about that.
And as I mentioned up front, we're long-term shareholders. We've owned Ultra Petroleum in our funds for over 7 years now. We consider them to be the lowest cost provider of natural gas in the United States. If you look at their return on invested capital profile over time, they've achieved tremendous results. We think the combination of that plus the fact that they can grow their production profile dramatically going forward gives it a very strong investment case. Natural gas specifically has been under fire more recently, but as a hydrocarbon, it's actually very compelling relative to oil for the environment. And we think that the disparity between natural gas and oil is at an all-time high and probably won't remain there forever.
Whenever I talk to people about natural gas investments, I have to be curious about what just happened in San Bruno, California, for example. Whether you were talking about any type of petroleum product, there's been increased scrutiny on safety. Is that a concern for you at all?
It's a marginal concern. I think there's a misperception, at least for natural gas companies, that some of the drilling could lead to negative environmental impacts. But I think nothing to the degree that we witnessed in the Gulf. In fact, relative to some of the deep drilling in the Gulf, many of these companies have much more safe drilling profiles, in our opinion.
Let's get to your next pick, and this is a well-known name in the investing community, MSCI, although many people know it because of their products, not necessarily as an investment itself.
Sure.
This, of course, the operator of the MSCI, the various indices around the world that many people benchmark. So, I mean, how does this company make money, and how is it going to grow what it makes?
Well, as you said, this is a great business because they represent a standard in the investment community. And once you create a standard, kind of like the S&P 500, it's very hard to envision that changing even 5, 10, 15 years from now. So I think it's likely going forward that people investing money in the international arena will be using this benchmark simply because everyone else does. There's a network effect there that's a huge benefit. And they get paid primarily for the usage of these benchmarks. So as more and more money over time is invested in international-oriented funds, et cetera, they should be a primary beneficiary.
And what about about in terms of growth, in terms of new products and new indices? Is it hard to, even though they have sort of the brand name out there, is it hard to get people on board for new products?
Sure. I mean, as the world becomes more international, there's more and more benchmarks that can be created that are more local. I think there's a benefit there. And in addition, there's analytics around these benchmarks that a lot of companies and investors find interesting and useful. So it's not just the data itself or the benchmarks themselves, but also some of the advice and analytics that come along with understanding those benchmarks. Very strong franchise with really no capital requirements.
And let's get to your last pick, Mead Johnson Nutrition, primarily a maker of infant formula and Famil, or if I'm saying Enfamil, that would make more sense. And it's interesting because you think about sort of formula, non-formula trends here in the U.S., but of course you also have to think internationally and demand for formula. So what is the company seeing on that front?
Well, I think particularly internationally, there's a big benefit that they have with the world becoming more urbanized, with women coming back into the workforce in some of the emerging markets. That leads to less breastfeeding and more need for products like Enfamil. And we all know that there's the one major investment in all of our lives is our children, and the only thing you don't want to cut corners with is how you provide for their development. And Enfamil is the premium product for infant development.